If you've been putting off a financial decision, July 2026 might be the month that decision makes itself without you. Three major changes are coming that could directly affect your Social Security, Medicare, your taxes, and how much money actually lands in your bank account every month. And here's what matters most. Some of these changes don't require congressional approval or a new law. They're already set in motion. That means waiting until July to understand them could cost you thousands of dollars you didn't need to lose. Let me walk you through exactly what's happening, why it matters to you specifically, and what you need to do right now while you still have time to make a real decision instead of scrambling to react. The first change coming in July 2026 involves something that affects nearly every senior in America who receives Social Security. The Social Security Trust Fund is projected to hit what experts call depletion. And I want to be very clear about what that actually means, because there's a lot of confusion and, frankly, a lot of fear-mongering out there. Think of the Social Security Trust Fund like a savings account. For decades, millions of workers paid into Social Security through payroll taxes. The government didn't spend all of it immediately. They kept the extra money in this trust fund, earning interest. That money was supposed to act as a safety net during years when more benefits were being paid out than money was coming in from current workers. Well, we've reached that point. The trust fund is nearly empty. Here's what happens on that depletion date, and this is critical. Social Security doesn't disappear. Benefits don't stop. But the law automatically triggers what's called a benefit cut. According to the Social Security Administration's own projections, if nothing changes before July 2026, monthly benefits would be reduced by approximately 21% across the board. For some recipients, that's manageable. For others, it's the difference between staying in their home and moving into assisted living. Let me give you a real picture of what this looks like. Margaret Chen is a retired librarian in Portland, Oregon. She's 68 years old and currently receives about $1,900 a month in Social Security. That's her only retirement income. A 21% cut would reduce her monthly check to about $1,500. That's $400 a month she wouldn't be receiving. Multiply that by 12 months, and Margaret loses nearly $5,000 a year. Over 5 years, that's $25,000 vanished from her retirement plan. Now, Congress could pass legislation to fix this problem before July 2026. They could raise the payroll tax cap, adjust benefit formulas, gradually raise the full retirement age, or increase the tax rate itself. Some combination of changes could keep the trust fund solvent and reduce the benefit cut significantly. But here's the reality. We're less than 2 years away, and there's no agreement on how to fix it. Congress moves slowly, compromise is rare, and frankly, politicians tend to avoid making unpopular financial decisions until they absolutely have to. So, what do you do about this? First, request your Social Security statement right now if you don't have one. Go to ssa.gov and create a My Social Security account. Download your complete earnings record. Verify that your work history is accurate. If there are missing years or incorrect amounts, report them immediately. Social Security has a limited window to make corrections. Getting this right now matters because your future benefit amount depends entirely on what's in that record. Second, consider whether your current claiming strategy still makes sense. If you were planning to wait until 70 to claim Social Security because you wanted the maximum benefit, this changes the math significantly. If that maximum benefit is going to be cut by 21%, the advantage of waiting might not be as strong as you thought. Some people should still wait. Others might benefit from claiming sooner. This is deeply personal and depends on your age, your health, your other income sources, and your family history. But the July 2026 change absolutely means you should revisit this decision with a financial advisor who specializes in Social Security strategies. Don't just assume your old plan still works. Third, start thinking about how you'd adjust if a benefit cut does happen. Would you need to work longer? Could you reduce spending in certain areas? Do you have other income sources you haven't tapped yet? Having a backup plan isn't pessimistic. It's responsible. It's the difference between being forced into panic decisions and making thoughtful choices. Now, let's talk about the second major change coming in July 2026, and this one affects Medicare, specifically your out-of-pocket costs. Medicare has something called the donut hole, which sounds like something fun, but is actually a gap in prescription drug coverage that can be extremely expensive. Here's how it works. When your prescriptions cost between $4,440 and $10,395 in a year, you're in the donut hole. During this period, you pay a higher percentage of your drug costs. You're responsible for 25% of the cost of most brand-name drugs. That can add up incredibly fast, especially if you're taking multiple medications for chronic conditions. In July 2026, the law automatically extends the discount on brand-name drugs throughout the entire donut hole. That means your cost won't jump from that subsidized amount to full price once you hit the gap. This actually sounds like good news, and in many ways it is. But here's where it gets complicated. Insurance companies and pharmaceutical manufacturers might adjust how they price drugs or what they cover to compensate for this change. Some people might see lower out-of-pocket costs for certain medications. Others might find that their medications have shifted to a higher tier, or that their preferred pharmacy has changed. Some insurers might adjust their premiums. James Rodriguez is a retired carpenter in Tampa, Florida. He's 72 and has type 2 diabetes and high blood pressure. His current Medicare Part D plan costs him about $35 a month in premiums, and his out-of-pocket costs average around $200 monthly for his 3 medications. When the donut hole changes in July 2026, his out-of-pocket costs might drop to $150 a month. That's $50 of savings every single month. But his premium might increase, or his pharmacy might change, or his insurance company might cover a generic version instead of his preferred medication. The takeaway here is straightforward. Don't assume your current plan will remain the best option after July 2026. Medicare has an open enrollment period every year from October 15th to December 7th. This year, between October and December 2025, you should carefully review all available Medicare Part D plans for 2026. Compare the premiums, the formularies, and the projected out-of-pocket costs for your specific medications. Yes, this takes time. Yes, it's confusing. But switching to a better aligned plan could save you hundreds or even thousands of dollars over the course of the year. And if you have diabetes, heart disease, arthritis, or take multiple medications, this is absolutely worth your time. This is also an excellent moment to subscribe if you haven't already. We cover Medicare changes, Social Security updates, and tax strategies specifically designed for seniors. You'll get notified the moment new information comes out that could affect your benefits or your costs. The links are in the description below. Now, the third change coming in July 2026 is less well known, but potentially just as significant. It involves how Social Security benefits are taxed. Right now, if your combined income exceeds certain thresholds, a portion of your Social Security benefit is considered taxable income. For single filers, that threshold is $25,000. For married couples filing jointly, it's $32,000. But in July 2026, some states are implementing new tax rules that might affect seniors who receive Social Security. Actually, let me be more precise about this. Individual states have the authority to decide whether to tax Social Security benefits at the state level. Federal law doesn't tax most people's Social Security benefits heavily, but 13 states currently do. And some of those states are adjusting their rules for 2026. If you live in Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, Rhode Island, Utah, Vermont, West Virginia, or Illinois, you need to pay attention to your state-specific rules. Here's a concrete example. Robert Williams is a retired accountant in Denver, Colorado. He's 64 and receives $1,500 a month in Social Security. His wife, also retired, receives $1,200 a month. Together, they have a small pension and some investment income. Their combined income puts them in a bracket where Colorado taxes a portion of their Social Security benefit. In 2025, they paid about $300 in state taxes on their Social Security benefit. But Colorado's rules are changing for 2026, and their tax bill might increase. The action item here is clear. If you live in one of those 13 states, visit your state's Department of Revenue website and look specifically for Social Security taxation rules. They should have updated information for 2026. If you're married, involve your spouse in this conversation. If your income is close to the threshold where taxation kicks in, you might actually have options, like moving money into certain types of accounts or adjusting when you withdraw from investments. I'm not recommending any of these strategies, but a tax professional who understands your state's rules can tell you whether they apply to your situation. Now, there's something important that ties all three of these changes together. They're happening at the same time, during the same month, in the same year. If your Social Security benefit gets reduced by 21%, your Medicare costs might increase or decrease depending on your plan, and your state taxes might change. The cumulative effect on your monthly cash flow could be much larger than any single change. This is why now, not in June 2026, not in September, is the time to actually plan. Let me walk you through the steps you should take in the next 60 days. First, pull your financial statements. Social Security statements, Medicare statements, bank statements, tax returns. Get your actual numbers in front of you. Don't estimate. Actual numbers. Second, create a projection for your 2026 retirement income. Factor in the possible 21% Social Security reduction. Look at what your Medicare costs might be under different plans. Account for any state tax changes. What does your monthly budget look like? Can you absorb these changes, or do you need to make adjustments now? Third, if you're currently not yet claiming Social Security, schedule a consultation with a financial advisor who specializes in Social Security claiming strategies. This costs money, typically between $200 and $500 for a comprehensive analysis. But that analysis could show you exactly how the July 2026 changes affect your specific situation and whether your original claiming timeline still makes sense. That's money well spent compared to the tens of thousands of dollars a wrong decision could cost you. Fourth, during Medicare's open enrollment period, this October through December, don't just renew your current plan automatically. Sit down and actually review the alternatives. Check your medications, check your doctors, check the premiums and out-of-pocket costs. If you're over 65 and haven't yet enrolled in Medicare, don't put it off thinking you have until 2026. Get enrolled now. Missing the initial enrollment deadline comes with penalties that stick with you permanently. Fifth, if you live in one of those 13 states that taxes Social Security benefits, talk to a tax professional about your 2026 situation. You might find that a small adjustment now, like adjusting your withholding or reordering when you take distributions from retirement accounts, saves you hundreds of dollars in taxes. Now, I want to address something that I know many of you are feeling right now. There's fear. There's uncertainty. You've worked your entire life. You've paid into these systems. And now you're watching politicians debate whether they'll actually honor the commitments they made. That feeling is valid. It's normal. But here's what I want you to know. You're not helpless. You have agency. You can't control what Congress decides. You can't control what pharmaceutical companies charge. You can't control your state legislature. But you can control your planning. You can control your knowledge. You can control your actions right now, while you still have time to make thoughtful decisions instead of reactive ones. Dorothy Martinez is a widow in San Antonio, Texas. She's 73, and like many of her friends, she was worried about all these changes. But instead of waiting and hoping it would work out, she spent 3 hours pulling her statements, meeting with a financial advisor, and reviewing her Medicare options. She found out that switching to a different Medicare Part D plan would save her $60 a month. She verified her Social Security earnings record and found 2 missing quarters from when she was young that actually increased her benefit slightly. She consulted with a tax professional and learned how to structure her income to minimize the impact of the state tax changes. Altogether, those steps took maybe 5 or 6 hours of her time, but they positioned her to not just survive the July 2026 changes, but to handle them with confidence and minimal stress. You can do the same thing. To be absolutely clear about what you should do right now, first, visit ssa.gov and create or update your My Social Security account. Second, download your Social Security statement and verify your earnings record. Third, mark your calendar for October 15th to start reviewing Medicare plans for next year. Fourth, if you live in one of those 13 states, research your state's Social Security tax rules. Fifth, if you're not yet claiming Social Security, schedule a consultation with a qualified financial advisor. And sixth, consider talking to a tax professional to see how the 2026 changes might affect your specific situation. These changes are real. They're coming, but you're not facing them alone, and you're not facing them unprepared. The information is available. The tools are available. What matters now is taking action while you can still make a choice, instead of being forced into one. Your retirement is your responsibility. The system should support it, but planning for the unexpected and staying informed is what actually protects it.